So today I'll be talking about 5 things that I would do differently if I was just starting to invest in the UK. Let's go straight into it. Number 1, I would start early. Despite the fact that I'd been investing for practically a decade in Nigeria, it took me a year before I started to invest in the UK. Why? Because I was a bit nervous. I was worried about doing things wrong because it was a different environment. I say this a lot. The principles of personal finance, of investing, they are unchanging, right? But the application varies from place to place. And I wasn't sure about the application in this country. I knew how to identify the right companies to invest in. I mean, I'd been doing that for over a decade in Nigeria, but I wasn't sure what platforms to invest in, how to go about investing, how to handle taxes, because again, that's a bigger point in this country. A lot of my investing fundamentals were more US leaning than the UK leaning, and I needed to know how things worked here. So I hesitated. Now, it makes sense to hesitate to get more information, but I could have easily gotten that information without waiting a whole year. Hindsight is always 2020. Now I know where to get that information. So if I was starting all over again, I would find out what I needed to find out quickly within a month, and I'd start investing. Why? Because I was fortunate to have received a bonus when I was moving here, but I didn't know what to do with it. So that money just sat in my account. Eventually I used it for rent and a bunch of other things. Of course, I invested some of it, but that's something I would have done differently. I would have invested that lump sum right at the start of my move here. And why do I say lump sum? I mean, I could have done what other people talk about. People talk about dollar cost averaging. They suggest that a lot. But if you actually do the math, if you have £10,000 today, right? Let's say you moved from Nigeria to UK and your company gave you a transfer allowance of £10,000 to help you settle, right? If you put £10,000 in, even if it's a savings account that is calculating 4.5% per annum, if you put it in January, you basically have 4.5% of 10K by the end of the year. Now, if you had done what a lot of people suggest, which is, for the sake of caution, let's drip feed that £10,000 into your investment. So in this case, we're using a basic high interest savings account, right? And you're getting 4.5% in that savings account. Unfortunately, you're only putting in, let's say, £1,000 every month for the next 10 months. So that means you only get the full 4.5%, because it's 4.5% per annum. You only get the full benefit on the first £1,000 that you put in at the beginning of the year. Because the next month when you put in the next £1,000, you have a shorter period of time for that money to stay invested. So you will not get the full 4.5% impact on that 1,000. The next month you put in another £1,000, it's even worse. You have a shorter period of time. So you've invested the first 1,000 for a year, the second 1,000 for 11 months, the third 1,000 for 10 months. And the fundamental fact about investing is the longer the funds stay invested, the more you're likely to make from that investment. You'll ask me, why do people usually suggest dollar cost averaging? It's simple. Caution. Because we're using a fixed 4.5% in our example here because we're talking about a savings account. But if you was a stock market and you were investing in, say, 2025, you wouldn't have a fixed sum. What you would have experienced is probably something close to maybe a huge jump. When Donald Trump was sworn in, the US drives roughly 60 to 70% of the global stock market. So if you had invested in a global ETF, for instance, and if you invested in January, you would have experienced a huge jump when Donald Trump was sworn in. And then you'd have experienced a huge dip in April when he came up with his tariffs. And then you'd have experienced another reversal after he postponed the tariffs. And then you would experience another dip when he had the spat with China. And that's actually how the stock market works. It goes up and down, up and down, up and down throughout the year and for a long period of time. But the good thing about the stock market is, despite that volatility, in the long run, it's still trending upwards. So if you stay invested for the long term, you have nothing to worry about. But if you're one leg in, one leg out, then perhaps dollar cost averaging is safer, because some months you buy at the top, some months you buy at the bottom, so you even out the returns over time. But honestly, it doesn't matter much. In the long run, it's the person that stayed invested for the longest period that makes the most from the stock market. As the saying goes, don't try to time the market. Time in the market, time invested in the market is more important than trying to time the market or time when to invest in the market. So that's the first point. Quick heads up, I will be running a 30-day live course built specifically for African expats in the UK. The goal is simple: to move you from just earning a salary to owning assets in the UK. We're going to make it practical, step by step. Taking an action a day will move you from one end to the other. I'll show you the exact platform that I use, how I structure my investments, and I'll even share some of the personal templates that I use to track my own money. If that sounds like something you'd be interested in, leave a comment below and say 30 days, and I'll send you the link to register for the course. Now, the second point I've alluded to earlier. When I first got to the UK and I started investing, I basically applied the same principles that I had applied in Nigeria, which worked. It worked for me in Nigeria. Basically, I would go, pick a bunch of companies, analyze their books, check their performance over the last 5 years. Have they been making profit? Has the profit been growing? Have they been declaring dividends? Are they well priced? Are they undervalued? When you do the price to earnings ratio, price to book ratio, compare the price to their earnings or to the value of their assets. Do they have working capital? Those are a few of the things I usually look at. And then I do that analysis and select a few companies. And over time, some of them would outperform the others, but my portfolio in general would do well. That worked for me in Nigeria, and I was going to apply the same principle here. But one thing that I never did in Nigeria was to invest in the stock market using funds. I think I tried it once. I basically let the investment company choose which companies to invest in, and it didn't perform well. Here, it's actually a lot simpler because you can actually get funds here that expose you to the global stock market, not just the stocks in your own country. With that, you can just track the global stock market instead of trying to identify which company is doing well this time or this year or versus last 5 years. You can just set and forget. Pick one ETF. ETF basically means exchange traded fund. Pick an ETF that basically tracks the entire market. The entire market could be the UK market or the US market, which is more popular because that's 60 to 70% of the global stock market, or better still, a fund that tracks the global stock market. So you have funds like VWRL, VWRP, FWRG. Basically, these are all world ETFs, right? I like to use the acronyms because they're easier for me to remember when I'm searching. Those acronyms actually change depending on which market you're at. VWRP and FWRG are essentially the same thing. They're just offered by different ETF providers. I have a clip somewhere where I did a very nice explanation of what an ETF provider is, what an ETF is, what a fund is, what an index is. But bottom line, it's easier and simpler to identify one or two funds that you want to invest in and set and forget about it. You are not analyzing any company's financials. You are not doing it's the ultimate passive investing. You just identify a fund that tracks the world or a market or an industry. It gets riskier if you narrow down like that. I prefer to keep it as a globally diversified fund, but identify that fund, put your money in there, set and forget it every month, and that's it. So that's the other thing I would have done. Instead of me trying to analyze companies, spending time and months figuring out which companies to invest in here, I would have just picked a fund right from when I moved here, taken my lump sum, picked FWRG, and thrown it in there. And then later on, if I want to dabble, I can now start to do the analysis and pick maybe the top 5 or maybe the top 10 companies on the FTSE 100 and analyze their books and see which ones I want to actually put a bit more money on. So that's the second thing. The third thing I would have done differently would have been to deprioritize crowdfunding. There's this website called Crowdcube that I usually go on. Again, it goes back to my tendency to try and analyze and identify winners. So on Crowdcube, you can actually invest in startup companies, right? It's very risky. It's highly risky. But I still prefer to invest there than do crypto because I feel I'm still investing in a company. Companies like, I think, either Monzo or Trading 212 started off on Crowdcube. Even Invest Engine actually started off on Crowdcube. They raised funding on Crowdcube. And I invested in Invest Engine then. And I currently use the service. And I mean, as far as I know, they're doing quite well. They haven't gone public yet, but they're doing quite well. One reason why investing in startups in the UK is not such a bad idea is there are tax returns. So if you invest in a startup that has an EIS license, either an EIS or SEIS license, but if they have that, it gives you, the investor, a 30% tax rebate that you can claim. So even if the business doesn't do well, you still get some form of benefit from HMRC for investing in that company. So there is some value to investing in crowd-funded startups in the UK. But the truth is, I wouldn't have focused too much on looking for one or two startups on crowdfunding websites like Crowdcube. That should be like the last, or second to the last, if you consider crypto. It should be the last thing you consider after you've done your regular investing, preferably using ETFs. And you've done the fourth thing I'm going to talk about, which is having an emergency fund sorted. So if I were to start investing again now, I'll make sure I had my emergency fund in place. Because if I had a lump sum, number one would be to have an emergency fund in place. And then two, invest the rest of that lump sum as a lump sum, not drip feeding it over time, before I now start exploring individual stocks or crowd-funded startups. So those would be things I would prioritize, because sometimes we underestimate the importance of having an emergency fund. An emergency fund is basically 3 to 6 months of your monthly expenses. You're not investing it. You put it in a high interest savings account, not a regular savings account, one that gives you a high interest. That's something else I would have done differently, because when I did have savings, I wasn't making sure to put it in a high interest savings account. I was looking for high interest savings accounts, but I didn't know where to find them. So I would try and explore with my bank at the time, Monzo. I would check if they had pots. I would use their pots to do my savings. But Monzo typically doesn't give the highest interest rates. The other place I tried, I remember going for Chase when they moved into the country, because they were, I think, 0.5% higher than what Monzo was giving me at the time. But I'll put the links below. There's a website that you could go to, Money Saving Experts, where they regularly update the highest interest rates being offered by savings accounts in the UK. So I would have gone there, found one of those companies, picked maybe a higher one with no restrictions, and then that's where I would put my emergency funds. So that's 4 things I would have done differently, but there's a bonus one I'm going to give you. 50 things that I would do differently if I was just starting over in the UK with my personal finances would be check my pensions. Now, when I say check my pensions, there are 2 things to check on your pensions. One is to see how much I'm contributing. Because depending on your employer, what I found out was my employer also contributes to my pensions, right? But the amount they contribute increases the more I contribute, up to a point. You could reduce how much you're contributing, and they would reduce how much they're contributing, or you could max out to a particular percentage, and they would also max out. And it's basically free money, right? It's an expense to your employer, but it's not a loss on your side. So I would check that. But the second and more important thing I would actually check is where that money is being invested. So I would check with the pension fund manager. In my own case, it was Aegon. I think it took me like a year or so before I found out that you could go to their web portal and actually identify which funds they invest in. The default fund is usually safe enough because the default fund, they usually use a lifetime fund, which basically allocates your pension investments in line with your retirement age. There's a default age. I think default age is 60. You could change your default age, but whatever age you set it to, they invest your funds in that way. So they would take, say, 60% of your money with them, basically. 60% of that money, they'll put it in stocks, and 40% of it, they'll put in bonds. And then, depending on how far away you are from that age, it could be 80%, 80-20, right? So put 20% in bonds, 80% in stocks. Then as you grow older, as you get closer to your retirement age, you start to reduce the amount that they have in stocks and increase the amount that they have in bonds. And then depending on how you have configured it or what you've told them you want to do with the money at the end of the day, do you want to collect it as cash? Do you want to buy an annuity? Do you just want to take a bit of it, the amount you can take tax-free, and leave the rest invested? Depending on whatever the option you've chosen, they would reallocate your investments in line with that. So if you're collecting everything as cash, they will start to increase the cash portion of that investment. Long and short of it is, if I'm 10 years away from retirement, instead of the 80-20 or 60-40, I would rather just put 100% stocks. Because 10 years is a long time. Personal opinion. 10 years is a long time to stay invested in the stock market, right? It's long enough for you to have ups and downs. But over that 10-year period, historically, what we've seen is the stocks will trend up. Now, there are times when you could start investing at the peak and there might be a recession at the end of the 10 years. But generally speaking, you have more times when the market is up than when it was down, which is why people talk about crashes all the time. So what I would do, which I eventually did, what I did was go into my pension manager's platform and I basically split my pensions into two parts, right? So half of it, I still live with them to manage as they like with the old 60-40 or 80-20, whatever. But the remaining half of it, global stock market ETF. That's what I did. So basically 50% of my pensions is in global funds. Then the remaining 50% I left to the pension manager to manage. I like to do that because I like to also compare. And every time I do it, I did it with Invest Engine. So I have a small portfolio with Invest Engine that I allow them to manage. And then bulk of my funds, I manage myself. But when I compare the performance of my own personally managed portfolio with the portfolio I left for them to manage, my portfolio has grown more. It's the same thing with my pensions. When I compare the 50%, the percentage keeps growing more than 50% because it's performing better than the other half that I gave to them. All right. But at least I know, even if I'm being conservative with the 50%, the remaining 50% I can be aggressive with it. So that's the last thing I would do differently. Just a note on this, me investing versus professionals investing. My own funds are not doing better because I'm such a genius or I'm such a stock market guru. No, they're doing better because I just invest in the market. Because the managed funds are trying to outsmart the market. So sometimes they do, sometimes they don't. But the market is like the average, right? So all I do is just put that money in a globally diversified ETF and it keeps growing and outperforming all these other managed funds. So not because I'm a genius or anything. So that's it. I hope you found that helpful. If you did, please leave a comment below. Check the description. I'll leave links to all the things I talked about, the websites where you can get recommendations on which banks or financial institutions have high interest rates for your emergency funds, and the link to my portfolio and Invest Engine. And yeah, I'll leave links in the description of the video, but you leave a comment and let me know if you found this helpful. Most importantly, make sure you act on something that you heard in this video, because we need to make sure that we get our money growing. All right, have a good one.